Markets actually declined after the Fed rate cut. On Wednesday, the Fed announced they would lower their benchmark overnight borrowing rate by 0.25% to a range of 3.75 to 4%. Now, this marked the second consecutive cut of 25 basis points, and there's still one meeting left this year where we could see, perhaps, another rate cut. The key word here is could, and the lack of conviction around another rate cut is likely what spooked the market. Powell said a December rate cut isn't a foregone conclusion, and while recently appointed Fed Governor Stephen Moran again dissented in favor of a 0.5% cut, there was also hawkish dissent, with Kansas City Fed President Jeffrey Schmidt voting for no decrease. Schmidt's vote and Powell's language was likely what set the market lower after the announcement, as many essentially had the December rate cut factored in as a sure thing. Powell also added that there was a growing chorus among the 19 Fed officials to at least wait a cycle before cutting again. This resulted in traders lowering the odds of a December cut to 67% from 90% the day prior. Given the lack of data and an economy that still appears to be in a all-right position, I do believe the Fed needs to be careful cutting too quickly, essentially since they were taking another accommodative stance with the announcement that they would be ending the reduction of its asset purchases, a process known as quantitative tightening, and this will happen on December 1st. This, in theory, will stimulate the Treasury and mortgage-backed security markets, which should help with longer dated debt instruments, as the Fed was allowing these assets to just roll off the balance sheet, and now we need to step in and buy new debt to replace securities as they mature. While QT shaved off around $2.3 trillion from the Fed's balance sheet, COVID led to a major expansion from just over $4 trillion to close to $9 trillion. The question is, whether the rapid expansion just a few years ago was enough removed from the balance sheet to put it at a more normalized level. Like with the Fed rate cuts, I do believe if monetary policy eases too much, we risk a return of inflation and a further increase in many speculative assets that could cause problems, major problems, down the road. I'm Brent Wilsey with Wilsey Asset Management. If you like these videos, well, be sure to get a like or comment, and feel free to check out our other YouTube videos and weekly newsletter for the latest economic news, expert analysis, and market insights.